5 proven strategies to find money to invest in real estate. Now, we're a married couple with 3 kids between us. That would be Adam, Jocelyn, and Nick, and a couple grandsons, Zeke and Drake, and they live in Minnesota and Wisconsin. Like we said, we've been in the business a long time, helped thousands of people and renovated lots of property. But Jason did receive a historical preservation award from the City of St. Paul Architects for one of our projects we're going to share with you shortly.
We've also renovated a Frank Lloyd Wright home in Two Rivers, Wisconsin, and that one was featured on the Fine Living channel.
Now, we've also received many awards over the years because I've been in the business over 30 years. But one of them was being featured in the Wall Street Journal for being 96th in the nation overall agents. And so that was a real treat and a surprise. We were working really hard and didn't even know it was coming. But we also own multiple businesses: real estate, property management, construction, coaching, those kinds of things. And if we weren't busy enough, I just finished my first book. It's about to hit the bookstores. Look for it. From $5,000 to $6.5 million. You can too. It's my personal story of how I took a $5,000 inheritance from my grandfather to $6.5 million. We're going to tell you a little bit about that today, but you can read about it in detail because there's some great lessons to help you invest in real estate. Our second book, Should You Rent It, Flip It, or Run, which is our signature piece, is also coming out soon. And I feature avatars of different types of clients and how they build wealth with real estate over time. So it's pretty interesting, and I hope you'll find it helpful in your real estate endeavors.
Our biggest loves are being at our cabin in Montana. We love to spend time in the mountains, being outdoors. And Terry touched on our kids and grandkids. We go see them as often as we can. And of course, we have the 2 Labrador retrievers playing in the water. They're always keeping us on our toes. But one of the best things about knowing what we know is to be able to help other people achieve their dreams and goals through real estate.
Yeah, you might be wondering, why are they giving us this information? And we live in Southwest Florida, and we have taught a lot of people, but we've had a lot of pressure nationally to be able to take our information nationally and help people wherever you are. People have paid thousands and thousands of dollars for coaching, and they're having a hard time getting it into play. I've actually worked with, about 100, 150 people over the last few years in that kind of situation. And so that's what we're doing here today. So with us today, you're going to learn the power of traditional financing, the types of financing, and how to be strategic utilizing it. I'm also going to teach you the secrets to finding and using private and hard money. And as I alluded to before, we spent a heck of a lot of money figuring that one out, and you're going to get the secrets for free. Imagine that. Now, IRAs are another great way to find money to invest in real estate, and we're going to explore that. You're also going to learn how to evaluate whether you should leverage assets that you own or somebody else owns in order to invest, and how to use rehab loans effectively so that you keep your cash and you can keep investing in real estate. And if I accomplish this with you today, you will be in the top 1%. And don't make the mistake. 99% of the realtors and investors and loan officers, I've been in this business a heck of a long time. I've met thousands and thousands and thousands of people. And I will swear to you that there is less than 1% of the people out there that know the information I'm about to show you backwards and forwards and are able to implement it in a great way. People tend to show you and expose you to whatever it is that they understand, and they haven't spent the time learning like you're about to learn today. So if you learn these concepts in and out, backwards and forwards, you will achieve something magnificent, your dream, because there's a lot of strategies here that will help your cash go a little bit farther. So our goal for you today is that you get a golden nugget. A simple thought, a technique, a simple strategy, or that can change your life in some kind of a way and move you forward to accomplishing those goals. So stay to the end, and I've got a couple free gifts for you. And one of them is a sample template of a pre-approval letter for private financing. And you need that in order to make offers if you get a private lender. And we'll talk a lot about that in the future. You're also going to get a link to private lenders that can be used for national and international investors. And though that link is private lenders who do not know you. There's a difference between the ones that know you and the ones that don't know you. We're going to talk more about that. But what's your big why? Why is it that you want to get involved in real estate? Are you interested in paying for college, or paying for your kids' college, or paying off your debt from college, or any other debts? Maybe retiring? We're in Southwest Florida right now, and there's a lot of retirees here. And sometimes, you know, you just need a little bit extra oomph in order to be able to go ahead and retire. Are you looking for a new business for yourself? Possibly a new home? You want some toys? Jason wanted to dirt track race, and he actually accomplished that along the way. Do you want a business to work with your kids or your spouse or someone else? Or how about a legacy? We ran into a gentleman recently, and he wanted to buy some investment property to secure a future for his grandkids. Met another young couple that needed investment property to pay for their kids' college in the next 7 years. So those are great, great goals, and those are great big whys. But you know what else happens when you have money? Disposable. You can do some things and help other people. And that's really rewarding, to be able to contribute to other people's lives and change them in a way that you never dreamed you could before. So the biggest problem, some of the biggest problems or common problems I see investors face is, how do I get started investing? And what's the best investment strategy? A lot of people will just call a realtor and say, I want to buy an investment property. And they say, well, why don't you just go call my loan officer here? And they say, how much money do you have and how much do you make at your job? And here, you're qualified. You know, if you want to buy this duplex, it's 25% down, blah, blah, blah. Or you're going to buy a house to live in. It's you know, oh, you've got money in the bank. Well, you're going to save money if you go ahead and put 20% down. Well, if you have a bigger goal and you use 20% down on your single family personal residence, maybe you used up all your cash and you can't go on to the next property. So those are some of the problems, and a lot of times people don't know how to go about keeping their cash. Now, who else should be on my team, or how should I finance my purchases? How can I find more cash to invest? Most of us only have so much cash. How can I estimate the repairs of cost of the renovations? Or what kind of offer should I make on the property? Is now a good time? I saw the downturn, or it seems like it's a little slow right now, or it's too fast right now, or is it going to fall soon? Is it a good time to invest in the marketplace? Do you know how to do market timing? Other problems are tenant problems. How do I find them? How do I manage them? Or I don't have any more cash. What do I do now? That's called eating your seed corn. Should I keep my job, or should I do the work myself? What's a return on an investment, or how do I calculate that? And what should I consider as a good cash flow amount for this property? Or do I need to get my real estate license? But by far the biggest problem I find early investors face is the lack of money. Or they have enough money to get started and they make their first deal, and after they've done their first deal, they find that they have eaten their seed corn and they're basically done, right? So don't let this fool you. Don't let it be you. It's a dream killer. So what I want you to get out of today is to be open and embrace each strategy. And I don't want you to eliminate if it makes you feel uncomfortable. I know a lot of times when I start talking to people about private money, their eyes glaze over and they're like, well, I don't know anybody like that. I don't have anybody in my family like that. I don't know anybody like that. Well, if you act like that, then you're never going to know anybody, and you aren't going to attract the money to you. So we're going to show you what happened to us, tell you our story on that, and hopefully you can repeat the process and attract good things to you. So don't eliminate it if it makes you feel uncomfortable. Get uncomfortable to get comfortable. Remember, without pressure, a diamond is just a lump of coal. So you should be here today if you want something more in your life. You need more cash to invest. You are open to new ideas and willing to take some steps to achieve that ultimate goal. You're learning based, and you choose to look positively at new opportunities. What we are not delivering today is any get-rich-quick scheme. We are not delivering one simple alternative to making money in real estate. Real estate does require hard work, learning, tenacity. Few people endeavor to make large sum of money, generally do. Most get lost from a lack of direction or inappropriate mentorships. None of the information we teach was taught to us in real estate school. It was learned through the School of Hard Knocks. We just hope to give you the concepts we've learned and embraced to help you be successful and avoid problems and pitfalls that we and others have experienced along the way. So therefore, we have a model that we teach you, and we're hoping you follow it so that you know, it took me 12 years back in the 90s to do this. Now, nobody was showing me how to do it. Nobody told me how. There was no books written on the subject, so it took me 12 years. Can you do it a lot faster? Heck yes. So let's get to it. So Jason, let's start with our personal story because I think it's kind of interesting because actually I had only $5,000 when I started and we were able to purchase lots and lots of properties, but that's by being strategic and figuring out how to get my seed corn back. So my story starts, I was a single mom, 1991 with 2 boys, and I found myself without a place to live. New in real estate, only been in the business about 3 years at this point. And so I had the choice. I could go to an apartment or I could find a place to live. Now, if you're in the middle of a divorce, it's really hard to get a loan. And if you're newly self-employed, it's hard to get a loan as well. So I didn't have many options. But if you're from St. Paul, Minnesota, you know that Summit Avenue is a heck of a nice place. Actually, it's the street that the governor lives on. And this is an 1889 brownstone. And my unit was the middle one that has a front porch there. And it went straight up, 4,000 square feet, 11-foot ceilings. And next door, where the bay windows are, is where F. Scott Fitzgerald wrote This Side of Paradise. So when I lived in this building, the tour buses would go on, stop out front and take pictures. And so my unit, you might wonder, well, if you're newly divorced, can't afford it, how could you do it? Nobody was trying to buy this property in those days. See, it had paneling everywhere and drop ceilings, and it was dungy and stinky, and the owners didn't want to take anything out of it. And I didn't need all the space, but I wanted a project. I knew if I just rented, I would be throwing my money away. Whereas I knew that the last few years when I'd watched real estate, that basically, even in a slow market, my house generally appreciated about the amount of my house payment every month. So I figured even if I didn't do anything to it, because I didn't have a lot of money, I would be money ahead in the end. It would probably go up in value. So I proceeded to go to work, and we lived in that house for a while. It was close to my office, and so I had about a 2-minute car ride to my office. And so as a new rookie agent, I did what most people do, is I decided that I would work really hard, and then I decided to seek out those opportunities that no one else wanted. Because I was in my 20s and I didn't want to compete with the old agents in my office. Most of them were 10 or 20 years older than me at the time. So I went after condominiums and started talking to the banks. They had these condos that they couldn't sell, and they were about $20,000, $30,000 a piece. But they were tired because they were foreclosed and they needed work and nobody was buying them. And I said to the bank, I said, on an expired listing, I said, why don't you let me paint it and do the carpeting? And in those days, nobody was fixing up property like that. And I said, but you need to let me do that because condominium buyers want to buy a finished product. They don't want to have to fix something up, or they want to buy a house, right? So the lady said, okay. And she gave me a listing. Of course, I did the job. And I started building on my successes. The next thing I know, I was known as the little condo queen of St. Paul. And I got this shortly after. I ended up getting a listing on Dale Street. And it was a twin home, kind of like the brownstones that I talked about, but in a much different neighborhood, very close to that neighborhood. But this is what I call the transitional neighborhood. Dale Street is a very busy street. And there was a lot of crime in the area and a lot of low-income people. And these units sit right on the busy street leading to the highway. And I had the units listed for $12,900 a piece. So you own one half of the building. It looks like a duplex, but it's not. It's a twin home, so it has a common wall. So my new bank guy had an idea one day, because after 250 days on the market, nobody was buying these properties. He says, Terry, I want you to go there all weekend. I want you to hold an open house. And I want you to collect sealed bid offers on these 2 units for $12,900 apiece. So, it was Minnesota, it was winter, and it was cold, and there was no heat. And I had to stand there like a new agent, rookie agent, all weekend. And as I stood there, I looked around and I thought, well, what if I did this? What if I did that? And I realized my grandfather had left me a $5,000 inheritance. And I thought, I wonder if I could transform this. I wonder if this neighborhood might get better. And I thought, well, I'm going to bid $5,000 on one of these, but I better own the other side because it's connected, which was a good strategic move. And so I took a $5,000. I said I could get $5,000 out of my credit card. And I did so, and I made my offer, $5,011 each. And the bank took my offer. There was another sealed bid, and the guy had bid $7,500 each side, but he played with them. He'd offered him $12,900 before, but he did not perform on the deal. Now, what I did with this property is I didn't have a lot of extra money. So what did I have to do? I had to earn my money to fix it up. I never lifted a finger personally inside because I was a single mom with 2 kids and a job, and I had to work really hard. So I had to work hard enough to earn the money to pay the guys to do this. And so it took a while. We got it done, and then I had to figure out how to rent it out. Nobody was teaching me. The other agents in my office were laughing behind my back, secretly hoping I would not succeed because I'd been the rookie agent, and I think some of them were old timers and they just didn't want to see that. So they weren't supportive and no one was helping me. Nobody was giving me any pointers. But lo and behold, I finally figured out how to rent the property. I rented them to Section 8 single moms, and they had a nice place to live because they were looking pretty good by the time I was done. It wasn't a full rehab because the property at that time did not call for that. The whole area was similar to this property at that time. So I rented it out. And then my next task was, though I had a lot of cash invested, how do I get my seed corn back? So I started searching, and I finally found a bank that said, okay, we'll refinance you. So what I did is I paid for an appraisal, and lo and behold, each unit came up and it was worth $40,000 a piece. So they gave me a loan for $25,000 a piece. I took my cash, I paid off my credit cards, and I still had $332 cash flow per unit to go ahead with. So I thought, that's pretty cool. That just paid at least for my car payment and a little bit extra. And so I started dreaming a little bit bigger, and I thought, well, what if I was able to cover my house payment now? So I went looking for the next project about a year and a half later and found a little house that was $10,000 and kind of repeated the process. So now what had happened is I found more projects to go on with, and I kept going. And so each time I would do it, I would get a little faster and a little faster, and I would figure out I'd have a better working crew, and I'd know how to find tenants better and all these kinds of things. Now, I didn't tell you, but I did eventually sell that property for $215,000 and $235,000 for the other side. And that's actually where Jason won that historical architectural award. Because what happened eventually with this property was it took about 10 years. And during that process, I'm going to show you where I met Jason and how. But we owned that property one day, and I started getting pressure from the neighbors. Well, actually, let me back up just a titch, because remember, I was renting it for $650 a piece. So what happened is I changed over tenants later on, and I realized I could get $850 because the rents were moving kind of fast a couple of years later. So when I had $850 aside, I thought, well, I wonder if I can refinance this property again. So I paid for an appraisal, and it came in at $80,000, and I was able to take $40,000 out a piece, or maybe it came in at $65,000. I can't remember the numbers exactly on the appraisal, but I know I took out loans for $40,000, and then I was able to take that cash and go buy a couple other properties. See, when you refinance property and take out that cash, that's not a taxable event. And I still have the same tenants in the property. Section 8 was still paying the $850 rent for a 3-bedroom. Now, eventually, this property would continue, and there's a lot of pressure on rents over this period of time, and the rents raised up to $1,200 a side. Now, I had to make a decision. Was I going to renovate the property and put a $1,200 a month tenant in there, which might or might not have been Section 8, I can't remember at the time, or do I go ahead and do my full renovation now? Now, this is an 1889 building as well, but it had 1960s woodwork in it. So if I was going to renovate it, I would want to do a full rehab on it at this time. But what happened is my phone rang and the neighbor called and started complaining about the tenants. And it wasn't that justified. And what happened is I realized, I looked at Jason, I said, you know what? All of a sudden the neighbors are complaining about my tenants, but you know what? My tenants are doing the same things they've always done. They're living the same lives they've always lived. The only thing that changed was the neighborhood. The neighborhood around them changed. Instead of my tenants fitting in, the neighbors didn't like them anymore because they didn't quite fit the way they wanted them to, which was not okay, but it was an opportunity. So we had the opportunity of renovating and increasing our rents to the $1,200 a month and keeping them there, or having the tenants move out and doing a full renovation. So what we actually did is we got a friend to buy the other 2 buildings. There were 3 buildings in a row, and we did a full renovation, and that's how we ended up getting those prices. Jason put back the architectural details that had been taken out over the years, and they were beautiful, and you know, they were just absolutely outstanding. At that time, it was the first time people were using stainless steel and granite and that kind of a thing. And so anyway, it was really fun. Now, I wish I could make great deals like that every day. It just happened. But remember, nobody wanted that deal in the beginning. So deals sometimes are not what you think they're going to be. Sometimes golden eggs are hidden, and they surface later by the circumstances around things. So it's a really great lesson to learn on this property. So I continued down the path, and I bought more properties, and I had about 15 or 20 properties when one day my phone rang, and that call changed my life forever. And on the phone were my friends Mark and John, or my soon-to-be friends Mark and John, and they're newbie investors, and they had just listened to someone called Carlton Sheets. You old-timers might recognize that. But it was a program where people were listening and figuring out how to build wealth with real estate. I hadn't learned about it. I didn't even know who that was at the time. But they had called me on this triplex I had listed here on Fuller Avenue. And it was a side-by-side 3-bedroom and 3-bedroom duplex with an apartment upstairs. And I had it listed for $74,900. So I met them over at the property, and we started talking, and they told me what their goals were. And I said, well, yeah, I own, 15 or 20 properties that I had just done what they wanted to do. So they were intrigued, and we started working together. They were my clients, and I taught them everything I knew. And soon we found that all of our energy together helped us all do better more quickly, and everything started speeding up. Until one day they introduced me to this gentleman, Jason, who affected my life. So you want to tell your story, Jason?
Sure. I had just moved to town, and like Terry said, in that top floor of that property was a small loft apartment, and I was renting that because I'd moved to St. Paul to be next to my daughter, to spend time with her, and had given up a job at a cabinet shop and taken a job driving truck again, which for me at the time felt like a step backwards. I loved doing woodwork. I loved doing carpentry. So I was working at a job that I didn't really love, but it was a good paying job. And that's actually the same job that Mark had for his day job. But his extra job, where he was just making some money on the side, so to speak, was doing real estate. And he was buying properties that needed some renovation. He had me come over and do some renovating on my days off. I was making some extra money, and I really enjoyed that. That was nice. I really needed it because my credit I'd been working at that point for a couple of years to repair my credit, and I had no extra money. It was paycheck to paycheck, trying to get by. And as I worked on his properties, I got to see what it was doing for him and his life and his lifestyle. He was able to have a very secure financial lifestyle. He had things that I didn't think I could ever afford to purchase. I thought I'd be driving my 10-year-old truck with 250,000 miles on it forever, not a new one. And but I knew I had to do something to change my life. And I talked to a real estate agent trying to get approved for a property, and they told me, well, yeah, you're doing the right thing. You're repairing your credit, but you're not there yet. You're going to have to wait, just stay in touch with me and we'll take care of you, 6 months down the road, maybe a year down the road. When I told Mark about that, as I was working on his properties, he said, you really got to talk to Terry. If anybody can help you, it's her. Quit talking to these other agents, go talk to her. So we met. Terry brought me into her office, and of course, first thing she did was, what's your goals? What do you want to accomplish? And for me, I wasn't much of a goal planner, but I did know that I wanted to quit my job. I wanted to work for myself. I did not want to drive truck the rest of my life. There's nothing wrong with that, but I wanted to be a self-employed carpenter. And so that was my goal. And in order to achieve it, I wanted to do it through real estate and to replace my income that was generated by my day job with rental properties. She explained to me the different financing things that she's going to go through with you. They were all foreign to me. I'd never bought a house before. I didn't know anything about it, but I trusted that it could be done. Matter of fact, she said, let's go to my loan person. They're not all created equal. So I did, and Terry went with, and within about a day, maybe 2 days it was, but I just had to do a couple of simple steps that the other person wasn't willing to do. And with a letter of explanation, Doreen was able to finance me with no problem. It had to be just a slightly higher interest rate, 1 or 2 points. I think it was 2 points higher than the going rate. But that allowed me to buy now instead of waiting another year. I was all for that. I wanted to buy now. So I was pre-approved and ready to go. That was pretty exciting. So I talked to my family and I was able to borrow $30,000 from my mother. Okay, so with that amount of money, Terry said, that's a nice nest egg. Let's not waste all this on one property. Here's what we're going to do. She laid out a plan, and within 6 months, we scoured the market, and within 6 months, we came up with 2 duplexes and 2 single-family homes, one of which my daughter and I could live in. One was a rental, so that gave me 6 properties, and 5 of them were income properties. And the money that it produced, that replaced my job. So I was just delighted. I quit my job, even though, realistically, I could have went on to buy more properties had I stayed with that job, but I was ready. I was ready.
Oh, instead you started dating me and we got married. So within a year and a half or so, we were married. And the interesting thing was, so I told you I started out with $5,000 in 1991, and we got married March 6th, 1999. And so at that point, I know I was worth $850,000, and I know Jason was worth $150,000 from zero, like a year and a half before.
Yeah.
So on that day, we were worth $1 million, and that was our story. So it kind of took me, without a model to follow, it took me about 8 years to get there, and I had to marry him to do it. Although I probably could have done it in another year or two on my own, but. Or another year maybe, so we did it. But the interesting thing was the second million came very fast. The second million came the next year. So what I want you to get out of that is, when you get started investing, the first deal takes a lot of learning, and you have to be tenacious. And then after you get it down, everything else becomes a lot more simple. So when I'm working and I'm coaching people, I really want to get you to learn, lay a great foundation. Therefore, we can build on that and speed it up for you. I carried a goal sheet in those days, and when I met Jason, and it was my dream board, and I share that sometimes with people. But and I taken my dream board had 100 rental units on it. So we eventually got up to, guess what, 100 rental units. We did not get to 99 rental units. We did not get to 101. We got to 100. And that was $26,000 cash flow per month. And so it was pretty amazing. But that was what my goal sheet said. I didn't make my goal sheet any bigger. And along the way, other dreams came about and got fulfilled along the way. And you can imagine that it wasn't my dream to drive a dirt track race car. It was Jason's. And
it was phenomenal. It was the best experience of my life.
so we had a lot of fun with that. It looks like I got a really good tax write-off here with my name on the car. And we were 40 at the time, so you can, the number on his car is 4D because Jason humor, when you learn Jason, when you meet him, he has kind of an odd humor, and 4D is Jason's humor. So with that, what goes up comes down, and we saw this real estate depression coming. We had a lot of units. We were trying to diversify, and we actually invested in a lot of different states: Minnesota, Wisconsin, Montana,
Mississippi,
Florida. So we had it going on, and we were diversifying based on market timing principles. So we saw it coming. We changed our business, helped a lot of people in the downturn get out before it was too late. In some cities were worse than others, and it was a trying time because that downturn took a lot of years, 5 to 7 years. And the way I talk about it is, we would approach people who were behind on their payments, and we would negotiate short sales for them on their properties to get the banks off their back. So essentially, they described it like this to me one day. They said, you know, Terry, I was walking around with a big backpack full of rocks, and I felt like I was going to jump off a bridge and die. And you came along and you took my backpack and helped me out of that situation. And we did that for a while, but I got kind of torn out. And after 5 years or so, I'm like, you know, I got to do something else. And we saw an opportunity in North Dakota.
Yeah, and we know I had a truck driver's license, so.
Yeah, so I'd identified hauling oil. If you had your 4 trucks going around the clock, you could make $1 million a year. So we went out there for a few years, and we were at the point, we had 2 trucks, and we were going to buy 4. And I realized that real estate was healing. And so we had made the break from Minnesota, and our dream is in Montana. So we went ahead to Montana to fulfill that dream and got our licenses there. And while we were there, we heard on the news, there was a radio, and it says, oh, this education event's going on. I said, hey, we got to go listen to that education event because we used to teach people in Minnesota, and let's get back at it and this kind of a thing. And when we went, what we realized that even though we were building wealth with real estate, there was a couple strategies that I didn't know how to do. So I talked about earlier, I didn't have a mentor all that time when I learned those techniques. And we ended up hiring a coach that taught us how to do private and hard money. We knew how to do everything else, but you know what? If you need a tool, I didn't have nobody else was knocking on my door. I didn't know anyone else to talk to about it. So we did it. We did a few levels in a program, and it was expensive. And so I don't think it's necessary to spend that much money to learn that at all. But we did learn new strategies, and that was private hard money, which then we evaluated our marketplace where we were at in Montana at the time, and we realized that we just put roots down there, and there weren't enough deals to make me happy. I like a lot of things going on. Jason's a little bit more of a simple guy. Yeah. And so there were only 35 houses in Montana in foreclosure. And I did my research, and I found out there were 5,500 in Cape Coral and 5,500 in St. Paul and 35 in Montana. So it wasn't going to work for me there. We had to go back to one of them.
Yeah,
so,
it was very simple math. I mean, there's only so many deals to be had, and the bigger market areas certainly had more deals.
Right. So we packed up the truck the next day, drove to Southwest Florida, and within a week we drove back and packed our things, and we were here by Christmas a month later. We actually had to give up my dream home. I'd put my dishes in the cupboard, and this is the kiss of death. And I said to Jason, I said, I'm putting these dishes in here, and I'm never taking them out again. I love this place. I love this. You know, I could hike in the morning, whatever. The kids are going to have to take my dishes out of these cupboards when I die. That's how long we're going to be here. Of course, we were moving like a month later. So sometimes you have to give up something in order to achieve something bigger that you want, right? And that's what I did at that time. So we got to Southwest Florida on Christmas Eve, and around New Year's, I saw a girlfriend of mine was staying on Sanibel. So I said, let's have New Year's Eve dinner. So we did, we shared our goals and we stated what we were doing in Southwest Florida, and they were impressed. And that was how we attracted our first private lender. Now that conversation was pretty interesting, and we had gotten coaching on how to do that, and it worked. And when we had gotten there less than a week before that, we had no idea who we were going to get private funding from, but we did it. And consequently, we treated our private lender well, and we never used a penny of our own money in the first couple of years doing these first rehabs. And it was pretty amazing. And once we did our first deal with them, they made good money in a short 2 months and 1 week. They made $12,000 on their money, and so they were happy. We made 30, we were happy. So we continued that partnership together. We didn't do it as a partner, we did them as just as private lenders. But after we treated them well, they found more money and invested with us. And so first it was 100,000 and later 250,000. And then as we got into it, we started to attract more people who wanted to give us money. In fact, just 2 days ago, we had an international investor say, you know what, I got $300,000 that you can use on whatever you want to use. So what happens over time is you get good at what you're doing, and you will cause other people to approach you and want you to, they don't have the time to do what you're doing. And so, but part of doing a private lender, and I'll get into this in detail in a few minutes, is being able to attract that and present it in a way so that, you know, you're doing them a benefit as well. Yeah, they're doing you a benefit, but you've got to make it a win-win. So we did some renovations. Sometimes they're big renovations. This is actually the after here is a vacation home. The before is a picture where we opened up this kitchen. It was a 60s kitchen and made it nicer. Jason put in some nice kitchens, and this is a low buck renovation home.
We did add pools on to a few homes during that time period because the market allowed for it. Actually, by studying the market, we could see that there was enough increase in value by putting a pool on to make it worth doing. Yeah.
Sometimes just staging a property can make it look better. This is just staging. Can you actually want to pay more for the second picture than the first, and it's the same property? All we did was stage it. You know, so all these kinds of things, again, some kitchens. But let's get into the meat of the matter, and that is the 5 proven strategies to define the money. So number 1 proven strategy is the power of traditional financing. Now, I told you my story because I wanted you to get the principal residence thing, because there's 2 games you need to be playing to build wealth with real estate, and that is, in my book, it's called the principal residence game, and then the investment game. And the nice thing is the IRS is very, very good to us on our principal residences. In the olden days, when I was growing up, you had to buy a bigger house each time you sold a house. That's not the case anymore. And now you can sell your house 2 of the last 5 years. You should always check with your accountant and not pay any tax as long as you didn't have rental income with that property and didn't depreciate it. So that's interesting because that means you can have a gain of up to $250,000 as a single person every time you sell it in those respects, and not pay any tax on that money. Up to $500,000 as a couple. Interesting, huh? But if you move over to the investment arena, if you sell that house, you're going to pay dearly, right? So there's also benefits to the principal residence game in the fact of the down payments are less. So what I tell my investors is I don't want you to be married to your principal residence. I don't want you to totally love your principal residence as I did my place in Montana, because that's dangerous, because you don't get to play the principal residence game then, which means you fix it up, you sell it, right? You find something that makes you extra money, and then you move on, right? So the benefit for saving cash with these programs is an FHA loan. These loans are called conforming loans. They conform to Fannie Mae and Freddie Mac guidelines. An FHA down payment is a 3.5% down payment generally. Veterans have the best gig in town. It's a 0 down payment, and there is no mortgage insurance or private mortgage insurance on veteran loans, the VA loan. So if you can qualify VA, by my goodness, we're going to go VA first. And maybe later on, if we convert that VA principal residence into a rental later on, we might go FHA on our next property a year later. So that's a really good game if you're playing the principal residence game, yeah? Get in, zero down, then rent that property out. Your VA is tied up, so you can't do VA again because you rented it. You still have a mortgage. Then we go and do the FHA game, 3.5% down, okay? So maybe think about this. What if you did a duplex? You do a duplex, then you got rent coming in. Boom, we go do a duplex again, right? Don't be married to your principal residence. We go do it again. Now you got 2 duplexes, and you only put 3.5% down plus closing costs. Pretty cool. Now what can you do? You could go get another duplex, or you could buy a single family house. But how are we going to do it now? Because you can only have one VA loan or one FHA loan, right? Well, we're going to do it with what's called a conventional loan. For owner occupants on the conventional side, these are still conforming loans. They are 3 to 5% down. If you're very strong, it'll be a 3% down payment. If you're a little bit weaker, not quite as much the income, anyway, it changes a little bit. It could be 3 to 5% down payment. Now, conventional loans have something called private mortgage insurance with them. If you have cash in the bank and you go to just any old realtor and any old loan officer and you have a lot of cash in the bank, I would venture to guess 85% of the time they will tell you, hey, you're going to save money by putting 20% down conventional, because by God, you are going to save private mortgage insurance. But you know what? If you're an investor, talk about your seed corn. If you spend 20% down as an investor, as a homeowner to buy that property, you just ate a bunch of your seed corn. You're getting in trouble. You can't go on and be an investor now, right? So don't let them sway you that way. We had a client call us up. He was a physical therapist. He'd spent a couple of years ago now. He was making over $125,000. His wife was making a lot of money too. And he was trying to rent a property from me for about $2,400 a month. And I looked at him and I said, why are you renting a property? It's actually easier to buy a property than it is to rent a property, and cheaper too. And he says, well, I don't have 20% down, or I don't want to put 20% down. He actually had it, but he didn't want to put it down. I would use all this cash. And I said, why? Who told you had to put 20% down? He says, my realtor. I'm like, are you kidding me? This is ridiculous. So that guy, he lost that sale. So I ended up selling him a $300,000, over $300,000 direct access, waterfront pool home. And anyway, so with 3% down conventional, pretty cool, huh? So you have to be savvy, guys. So now as an investor, investors have to put a little bit more down payment. Now, a single family, it's possible to get a 10% down investor loan if you're super strong. And multifamilies for an investor, generally at 25%, maybe 20% if you're lucky. If you're thinking about a second home, maybe a vacation home or something like that, maybe do some vacation rental in it too for part of the year. 10% down payments are kind of the norm if you're a strong buyer. So that's pretty exciting on the conventional end. Now, there is something called a non-conforming loan, and that is when you don't quite fit the standards of Fannie Mae and Freddie Mac. And what happens in those cases with these types of financing is that the down payments increase a titch, the insurance pool increases, and your interest rate increases. So you pay more. But if you can't qualify for the lower stuff, so what? You just pay more. You got to get into the property to make money, right? So you do whatever you can do, but that's a non-conforming loan. Now, up until this point, to get these loans, there's 3 things that you've needed. That would be a job, credit, and cash. Now, those of you self-employed without verifiable income, it's tougher on the job side, right? So sometimes, you've got to show your 2 years tax returns right now. You've got to have good enough credit to qualify for the loan. You've got to have enough cash or a gift of cash to get this loan. But what happens when you don't even have these things? Can you buy a house? Yes, you can. That's when we start implementing these types of strategies. Now, private and hard money financing really needs to be for investment property. There's something called the Dodd-Frank Act that basically there's some penalties for people who lend out money like this, and there are two homeowners that live in properties. It's dangerous. So most of the lenders require private hard money to be put on investment property. And a lot of times they make you do it in your LLC or your corp. It can be done personally too. It just depends on who it is, whether they're going to allow you to do it. But let's talk more about private money. What I want you to get out of this is that private money it's about anybody. Anybody and everything can, like my German friend the other day, he can be my private lender, right? It could be anybody. It could be my neighbor. It could be my brother. It could be my sister. It could be anybody, right? So in a private money loan can be done however you want. So the terms are whatever you agree on, right? You can pay it back on a 30-year term. You can pay interest only. You can have no payments and interest to accrue and be paid at a certain period of time. You could have a due on sale clause where it is paid, you pay so much now and then you pay it off in 3 years or 7 years, or you amortize it over 7 years. It just depends on what you're trying to accomplish. Now, how to find it is different. So there are those people, like I said, who know you, like you, and trust you. And those people, for private lenders, you're going to generally get a little bit better deal out of. And then there are private lenders who don't know you at all. For example, my friend who we had dinner with knew us, liked us, and trust us. So we got 100% financing plus the cost of the fix-up, right? You don't always get that. We had earned it, right? Because they knew us with time, and we were able to do that. But I did attract another private lender from Canada. And that private lender, he interviewed everybody about us and checked out our work and all of this. And then he said, well, I'll give you 70% of the purchase price and 70% of the rehab. So that's interesting, but I needed cash to do that. So what I did is I went back to my private lender who knew me and liked me and trust me and said, will you be willing to go in second position so I can do my no down deals this way? And they said yes, and we did it that way. Now, private money you secure with a note, and you put the person that's lending you the money on the insurance policy as well. So it's all up on the up and up, and it's on the books, and they're guaranteed to get their money back. So it is secured, and there's easy ways to do that. There are other ways to find money for private lenders, and I'm going to cover that as we go through the rest of the steps, and I'm going to show you how these other steps can play in to help you find more people to do private money. Now, the difference between private money, hard money, and I mentioned before those three things, you needed a job, credit, and cash. Private and hard money is really about the property, especially hard money. Hard money lenders, people think that they might be hard to find, but they're not. You could Google them right now and you'll come up with some. And they're all going to tell you a little bit different story depending on their lending guidelines. But what they're doing is they're going to say, bring me a deal and I'll tell you the terms. They'll tell you some generic ones, but until you bring them the deal and they look at the whole thing, their terms aren't going to be concrete necessarily. So what are they concerned with? They're concerned, are you getting a good deal on the property? Is there equity in it? Is the after repaired value after you fix it up, is there enough stretch in there for what you're going to do to fix it up for them to take the risk to give you the money? So they might say, okay, I'm going to give you 70% loan to value on the purchase and 100% of the rehab costs. And so what they do is they might fund it, and then they escrow those costs of repairs, and they disperse those costs after closing in increments as you do the work. It's a rehab loan within that. So you can do that with hard money. Now, hard money lenders will charge extra points, and those are where they make their money, or the people that are helping disperse the hard money about. So it's kind of interesting. It's generally a higher interest rate. The payment terms are generally more 30-year term type of a thing, or maybe a balloon in a year or two. Some of them are only for 6 months or a year. And if you want to extend that loan, you have to pay extra points. 1 point is 1% of the loan amount. And, so it can be costly, and there are lots of closing costs that can evolve out of utilizing this kind of a technique. Now, proven strategy number 3 is how to use self-directed IRAs. I love self-directed IRAs. You don't even have to have one to love self-directed IRAs, because there's a lot of ways you can find money to invest in real estate. Now, think back, my lender, right? My private lender I keep talking about. The money she was lending me was out of her self-directed IRA. So what it is she had a person who was qualified intermediary to direct her IRA. So she moved her money out of wherever it was to the self-directed IRA. Then she told that person to wire me the money for my closing, and that's called a self-directed IRA. So now, when in 2 months and 1 week she made $12,000 on the deal, I sent her 100,000 plus 12,000 back, and it went back into her IRA. She could not touch that 12,000 because it's in an IRA. She has to abide by an IRA standard. So people with with IRAs can become your lender. However, if they're going to do lending to you on the private money side, they cannot be your blood relative. So you really need to work with people who know what they're doing on these, so you don't mess up the rules, because you do not want to jeopardize someone's IRA and make them have to pay tax on it, right? Now, here's some other cool ways you can use IRAs. An IRA can purchase a property. So take, for an example, Jason. If Jason has a $200,000 IRA, he can direct his self-directed IRA to purchase that property for him. Now, rents are going to come in. He cannot live in that property. He cannot use it for personal use, but he can receive rents, but the rents go back into his IRA. And if there are bills to be paid, his IRA pays for the bills. So that's one way. There is another way. Say he didn't want to use all $200,000 for that property, or let's say it's a duplex. Say he said, well, I want to put as little down as possible. Then he'll come up with something called a non-recourse loan. And it's a different loan than we've talked about tonight. And this is actually an extra bonus that I'm throwing in. And so non-recourse loans, there's a few lenders around the country right now that will do them. Before the downturn, it was really hard to find one because I think they knew it was coming, right? So it's kind of safe out there right now. But the difference, a non-recourse loan, the lender cannot sue you in case of default. Other lenders can. Sometimes, depending on what state you're in, they can just take your property. But like in Florida, they can decide to sue you if they want to. They typically don't, but they could. Okay, we're a judicial state. So Minnesota is not. Minnesota is a advertisement. They do it by advertisement, and they're not a judicial state. So it kind of depends where you live. But anyway, so how Jason could do this is he would say to these non-recourse loans, say, tell me what the terms are. So each one's different. They might say, okay, we're going to give you a 60% loan to value, meaning you put 40% down of your IRA, and then we'll give you a loan, and it's going to be a higher interest rate. And depending on how they feel about you, the terms will be all different, right? And so you decide whether you want to do it if your numbers work or not, but that's one way to do it. Now, you can buy properties with IRAs another way. Say Jason has an IRA and his daughter has an IRA. They could both go and buy a property together with their IRAs. Now, their IRAs, depending on how much ownership each one, if one was 60-40, then 60-40% of the rents go that way. 60-40% of the bills and all of that. All the money goes back into their IRAs. You can also do it. You can have an IRA buy a property, and he could do it, and I could buy it with cash on my side, right? And so depending on our percent of ownership, I would put my cash in, and he would put a cash in from his IRA, and it would get split as well. So that's pretty cool. So remember that these sleeping IRAs can become your private lender, and you have to figure out ways to use them, right? But they can't, for being a lender, they can't be somebody blood relative to you. So a lot of times with private lending, what we do is we teach you how to build a credibility package and really teach you how to present yourself. And it's all about mindset and how you're going to attract that private money. There's really a science to it, and that's what we teach our investors. So with that, let's move on to proven strategy number 4, and that would be the power of leveraged assets. And I described that a bit, and I kind of gave you that example in my presentation on how I built that first property up over time. I had to decide, should I put an extra loan on this or not? And when my rents were raising up, I could afford a little bit extra payment because my rents supported that, right? But there was a time and a place after 9/11 and everything got kittywampus in the United States for a few years there. Values were going way up, and all of a sudden the rents weren't raising as fast as the values. And so when that was the point where I was getting really, really uncomfortable, and that's when we started looking for other places to invest, because it wasn't going, the rents weren't rising with the prices, and it got so bad that in the entry-level housing, meaning where your general people buy, the average person can buy an average house, the payment they were making for that house was significantly higher than what you could rent it for. So if there was a problem in the housing market, they couldn't rent it and cover their payments, so therefore we were getting in what I call the danger zone. So you want to be able to evaluate, is it a good thing to leverage your asset or not? Now, your principal residence is a great place to find cash for leveraged assets, because the money that you borrow against your principal residence is generally a low interest loan, like I showed you earlier, those traditional financing. You could put a traditional loan on it, but you would have some closing costs if you went FHA or VA or conventional, right? Now, if you don't want a lot of closing costs, another secret you can do is you can use a home equity line of credit. And in using that home equity line of credit, a lot of them don't charge you closing costs if you keep that home equity line open for at least a year. Some of them might charge you some, but the interest rate's pretty low. You may choose whether you're going to pay principal and interest or just interest back. So it's kind of, and it might be revolving on just how much money you use. So if you're using this money to invest with real estate, maybe you use $50,000, and then when you're flipping the property, then you pay it back, and then when you pay it back, you don't have to pay the interest. So it's a revolving account. So it's kind of a great thing. So it could be your principal residence, or if you know anyone who has a principal residence paid off or a lot of equity, they could do the same, and they could be your private lender, and they could be your blood relative, because now we're not talking about an IRA, we're talking about just money, right? So if somebody needs more money to live on, this is a great thing. So I like to tell this story. My grandmother, bless her heart, she's passed away now, but before she died, when we had some money at the time, and so we would always send her $300 a month, and I loved it because she would brag about that she would ride with the seniors to Nashville here and there and all of this. Once I gave her that $300 and she got used to using it, her lifestyle changed, and I couldn't take that away again because she was used to it, right? But think about this. Think about the people you know, maybe their house is paid off and they're on limited income. Perhaps they could leverage their house, take out a home equity line of credit, right? And their interest rate on that might be, let's say it's 4%. Maybe they lend you that money at 10%. Well, there's a difference of 6% there at $100,000. That'd be $500 extra a month somebody could live on. Now, if you do that with someone, you need to know that they have, on a home equity line of credit, a payment every month. So if you're doing that, you don't ever want them to worry about whether they're going to receive your payment or not. You need to be a week or two early. You need to be early on your payment so they never wonder. You never want them to have an anxious moment, because they won't ever do it again with you if they ever have an anxious moment. Now, here's another interesting thing. I didn't put it in. Another extra bonus you get today is something called a reverse mortgage. So if anyone you know is 62 years old or older and their property is paid off or close to being paid off, it's possible we could use a reverse mortgage. It's not just for those dang gone old actors on TV that you see and it says, oh, you're going to get a payment per month. Yes, you can do it that way, but think about a reverse mortgage this way. For example, let's say Thelma's got a house and it's worth $300,000 and she owes $20,000 left on it and she's 65. So a reverse mortgage, if she's planning on staying in that house the rest of her life until she can't stay in the house any further, she's not going to move anywhere else, a reverse mortgage is a good thing because there are no payments required on a reverse mortgage. She doesn't even have to qualify for the loan. The only thing she has to be able to show that she can qualify for is the taxes and the insurance that are payable on the house. So that's pretty cool. But they don't give her the full $300,000. My guess is they'd probably give her about $150,000. Now, in a reverse mortgage, she's sitting there, what did I say, a $20,000 balance. They would pay off her $20,000 balance on her principal mortgage currently, and then float that into her reverse mortgage. Now, certainly, she could say, just start sending me some payments. And if she takes those payments and she doesn't pay the interest, now these are FHA loans, so they have standard interest rates on them. If she doesn't pay that interest off each month, of course the balance goes up because the interest is there, right? But they're very safe, and they're monitored by FHA to protect the consumer, right? So the other thing, that's the common way we think about reverse mortgages. Now, what I want you to wrap your head around now is we've got all these baby boomers, and they're all 62 or older almost. And so what could happen next is, say it's that $300,000, it's $150,000. She could take the $150,000 in cash. Now they would probably pay off that first mortgage first, so she'd end up with 120 or 130 or whatever my numbers were. 130 cash. Now, what can she do with that cash? Anything she darn well pleases. She could become your private lender, right? So she could lend you that money at 10% interest and then pocket that money. Now, she's paying interest on that $150,000 at the FHA standard, whatever she got on the loan, 4 or 5%, whatever. But a reverse mortgage does not require the person to make payments on the interest until they move out of the house for over 6 months. So that means you die and move out of the house, or you go to assisted living and you're gone for over 6 months. Now, if she has a husband and he lives in the house for the next 30 years, he doesn't have to make payments back until he moves out of the house for over 6 months. It's a pretty cool system. So check it out. People aren't using that as well as they should. Now, you can leverage other people's property, as I said, and you should be real careful in figuring out whether you should or should not leverage assets. You don't want to do it in the wrong way. Lastly, our fifth proven strategy is how to effectively use rehab loans to conserve your cash and keep your seed corn to yourself. Now, rehab loans are pretty cool. Talked about that FHA product, that VA product, and conventional product. All of those houses that you're going to live in, you find a dilapidated house like this, looks like it's up north, you can do an FHA 203K on it. And that means you say there's $35,000 or less work that needs to be done on the property, from painting the floors, furnace, roof, outside, inside, windows, whatever you want it to be. You can't add a pool. You can't add a structure, but you can do a lot of repairs on the FHA side. On the conventional side, in Southwest Florida, you could add a pool even in there. So it's pretty amazing. And on the conventional side, you can go above that you can go up much higher in the amount of repairs. So what happens is they float the cost of those repairs into the end loan. So let's say the house is $200,000, it needs $50,000 worth of work. You qualify for a $250,000 house. They make you put on FHA 3.5% down payment on $250,000. They escrow the $50,000 and put it in a holding account, and then they let that go as you do the repairs, and they release it as per the contract that they have with you. It can also be done for investment property. Right now, investment property is not FHA or VA. However, conventional does have a rehab component, but only for single-family houses currently. That may change in the future. Now, investment property rehab loans are done, but we would go in the non-conforming arena or out to the hard money lending process in order to find that, or private money. So it's definitely doable and a great way to conserve your cash, because what you don't want to do is make your down payment for the house or pay cash for the house and then have to put all that cash into it. Now, if you do that, maybe you refinance it afterwards, or you wait 6 months or a year so you can get a new appraisal and appraise it at the new amount. So there's a big game, lots of ins and outs with all of this. And so I want to know, Is knowing these 5 proven strategic financing strategies enough to help you accomplish your goals in real estate? Well, that depends. Have you mastered all of the following techniques? These are the things. I mean, I know how to do these things forward and backwards, inside and out, right? But you know what? You also know how to do the rest of these things. And so if you need to know some of these things, you know, take note and make sure you learn them. So you improve your credits. If you have good credit, you've got more options. Simple as that. Use strategic financing as backwards and forwards all the time, and figure out how not to eat your seed corn, right? You also need to know how to calculate returns on investment. Utilize tax-deferred exchanges. Understand the anatomy of a home and the components of a rehab project. What should you do in what order to do the rehab project? How do you estimate costs of repairs of a rehab project on the spot? And feel confidently after viewing it and estimating them that you can go ahead and make an offer without getting in trouble, right? You should also know how to evaluate the marketplace and which technique you should use based on the current market timing principle. Are you positive that it's a safe time to invest? Different types of investment strategies are better in different time periods, meaning in the market cycle, absorption, expansion, the decline, and you can do it in all times of the market. You just have to know where you're at in the market cycle and which technique is best, right? So you need to also be able to identify multiple investment strategies. So at least you can't just say, I'm going to buy a property and this is it. You can, but if you have, a lot of times the best money we've made has been, you know, we went in and we thought, you know, I think we'll just rent this one, and then we get to the end of the project and we're like, let's sell it now. And it turns into a good flip, but it wasn't something we bought that way. Or even like that first property on Dale, you just don't know. You need to know how to evaluate the marketplace and how to use which technique based on that. So as I said, so you also have to have the right team of players. You need to know how to interview people, hire them, fire them. Oh, did I say that real loud? So we need some great workers in Southwest Florida, let me tell you. You need to know how to deal with contractors and how to protect yourself. There's some documents that you need and can easily protect yourself, and how to manage your team. And tax-related principles, you know, if you don't keep track of your receipts and you don't know how to use tax-deferred exchanges, you will end up paying a lot of tax. There's a spreadsheet that I run on all our properties, and I know exactly what my adjusted basis is. So I know what property I should do. I keep track of my total returns on investment so that as my total returns on investment decrease over time, I know which property I need to sell. It's not related to anything but money and earning money on money. So you should know how to establish fair market rent with your tenants, how to screen them. You should know the components of a lease. You should know whether you should hire a property management company. Sometimes it's good to figure things out on your own. Sometimes it's better to have somebody else manage your asset for you if you've got a lot going on and you don't have time or you're not present. You should know how to minimize the risk you have for a lawsuit with tenants. You know, people who do things out of emotion or don't cover their butts well end up getting sued. Anybody can sue anybody for any reason at any time, and if you get caught or somebody accuses you of discriminating, you could lose that asset and everything else you own. It's that simple. It's very, very simple, and it'll happen. So we've put in some strategies with our leases and our evaluation so that it's more objective than subjective, and you know, we would do better in court if we had ever got accused of anything, which we have not. But yeah, so anyway, with that, I want to tell you about our gift for you. And our gift for you is simply this: we've set a time aside for you to speak with you personally about your real estate investment business. You could be a novice or an experienced investor wherever you're at in your career, and this is free of charge. And you've been seeing our address at the bottom, and it's Terry with a Y, and I'm not a guy, and jason.com/apply. And so this call is really just to explore your dreams and your goals, identify any potential roadblocks or problems you might be facing in your investment career, and talk about strategies. It's all about strategy. It's not as simple as just going and buying a property. You're never going to get anywhere if you don't really know where it is you're going and how to get there, right? We're going to create a plan for success. And so if you have a dream or goal and you're willing to take steps to achieve it, and you're open to new ideas and feedback from others, and you're coachable, and you're willing to take steps to invest in your future, and you've heard some concepts that resonate with you here today, maybe you feel compelled to speak to us. We'd love to talk to you. Just go to this address, and it's going to take you directly into my schedule. And you're going to see a time, you're going to click the button, and that fast you're just going to be on my schedule, and we're going to connect and talk about those things. And our final gift, as promised, is our pre-approval letter for a private lender. It's really nothing fancy. It just kind of gives you the outline. You create your own, put it on letterhead, and then if the seller or agent requires proof, then you get a bank account statement from your private lenders to show that they have it. But simply, most of the time, I've gotten my deals done just by using a pre-approval letter like this. The link that I have for your private lenders is that link that I said is private lenders that don't know you, because they don't know you if you're linking in, right? So this group has been assembled, and they will give loans out, and they're actually not real high interest. I mean, they're like in the 6s or 7s. I don't think that's high. And depending on the terms, they will require a down payment, maybe 50%, 60%. I don't know. It's a negotiating thing. It's private lending, as I said. So those are because those private lenders don't know you. There will be others that will do different deals with you, but you're going to pound the pavement to go find those as well. But this gives you a start, so you don't have to pay total cash for a property. So go ahead and apply now, and terryandjason.com/apply. And we really thank you for this opportunity. We love exploring your American dream. Let's discover it together.
I want to thank everybody for coming in today and checking us out. And we look forward to talking with you soon. Thank you.
All right. Take care.